Are you tired of losing money in stocks because stocks fall soon after you buy them? Do you wish to join the elite club of the investors who actually invest based on the company fundamental analysis based on financial statements instead of following the herd? Trust me, it is not as scary as it sounds. I got your back. The good news is if you can read nutrition labels or baseball score, you can read the financial statements. Let's go to finance.yahoo.com and look at the Alphabet's financials. You will see last 3 or 4 years of the income statements and the most recent trailing 12 months or TTM. Remember, there are 3 types of financial statements. 1. An income statement. 2. Balance sheet. 3. Statement of cash flow. On an income statement, you will see the company's revenue over a specific period of time. Here it shows the last 3 or 4 years and trailing 12 months or TTM revenue and expense. The income starts at the top and the expenses are entered below that. You would have often heard the something is affecting the top line or bottom line of the company. The top line is the revenue line before the expenses deduction, and the bottom line is the net income after the expenses deduction. The net income is the company's total earnings. Earnings per share is derived from the income statement by dividing the total earnings with numbers of outstanding shares. The term EBITDA means earnings before income tax depreciation and amortization. Now let's look at the second financial statement, that is the balance sheet. It's called a balance sheet because it relies on accounting equation. Assets equals liabilities plus equity. Assets are what's valuable to the company to make money. Liabilities are the amounts of money that companies owe to others. In other words, all the obligations. Equity or shareholders' equity is the money that would be left if a company sold all of its assets and paid off all of its liabilities. This leftover money belongs to the shareholders or the owners of the company. The third financial statement is the statement of cash flow. Cash flow statements report a company's inflows and outflows of cash. Each part reviews the cash flow from one of 3 types of activities. 1. Operating activities. 2. Investing activities. And 3. Financing activities. The bottom line of the cash flow statement shows the net increase or decrease in cash for the period. There you go. You are a step ahead from the crowd now that you know the basics of financial statements. Stay tuned. In the next video we will talk more about what fundamentals to look for in stocks.